It's been a recurring theme since the beginning of crypto, really, it seems. It's that the idea of people can just printing money out of thin air. Then the question is, okay, do you blame the founders? Do you blame the market? Do you blame the VCs? VCs do get kind of a bad rep here because it's just easy to hate on them, but like they're generally not, in my experience from what I've seen, there's a lot of VCs who do not do this things that you see on CT, like, oh, they're just going to dump on retail sales. They actually don't really do that because it would nuke their reputation. The TLDR here, in my view, is first build something that people want, that is attached back to reality in some form, to some goods, services, exchange, something being sold. Once you do that, then you can start getting interested in the physics of a token launch and stuff like that. A lot of times when you do this backwards, it dilutes your PMF, or what you think you have in terms of traction.
This episode is brought to you by Helium Mobile. They've created a crypto native phone plan for unlimited talk, text, and data for just $20 a month. We'll chat more about them later in the show. Before we get moving on today's episode, just a quick disclaimer. The views expressed on this podcast by either myself, my co-host, or any guests are their personal views and do not represent the views of any associated organization. Nothing in the episode should be construed or relied upon as financial, technical, tax, legal, or any other advice. Okay, let's jump into the episode. All right, everyone, welcome back to another episode of Lightspeed. You're joined by Mert and myself today for a roundup. We're recording this episode on the 20th of May, so the Monday should go out ASAP. So we got a good turnaround time here, so keeping everything fresh and relevant. Right before we hopped on this call, actually, the Bloomberg fellows, the two ETF gods, if you will, have just upped their announcement, or they're upped their prediction odds of the Ethereum ETF being approved in the coming weeks to 75%. So it sounds like there's some internal chatter going around the SEC that kind of made them take a second pass at their predictions. It was at 25% before this. So hard to really know what the details are. Again, this just came out seconds ago. I think ETH is up like 20%, not 20, but 10% on the day now. Solana up about 8%. All of the alts following. So seeing some of that price action you would expect, given a surprise to the upside on the ETFs. We also saw the Grayscale CEO stepped down, which is interesting. He came in when Barry left and seemed to be doing a good job. So we don't have the full scoop there at all either. But yeah, it seems like they're seeing a positive move in Washington recently as it pertains to crypto. I mean, crypto's probably too small to really make a meaningful impact, in my opinion, in terms of what's happening in Washington. That's just how my base case. But you see Tom Emmer tweeting about crypto constantly right now. He plays a very important role. So I don't know, Mert, I'm curious if you have any takes around the ETF being approved, if that really means anything for crypto as an industry, or where your views kind of sit on that. We've never really talked about ETFs, so I'm curious.
Yeah, this is not really my area of competence, let's say. It's also not necessarily my area of interest either. I think there is kind of the side of crypto that is very much very, very finance, TradFi kind of integrations type with the ETFs and like certain RWAs. That's never really been my thing. So I honestly I'd be the last person that would be useful on this, I would say. But I mean, just from basic naive ground up thinking here, I don't see how it could be bad, right? I think more attention to Ethereum is good for crypto as a whole, right? So if boomers are like, oh, wow, Ethereum, what is this? And then maybe they do some research, and maybe their partners do some research, and maybe the network effects start coming in a little bit, and there's better SEO, there's better knowledge. It's not this mirage thing that is only sometimes on TV as a scam, and is actually this thing you can trade legitimately in traditional markets. I think that's a pretty big win. So I do hope it does get approved based on that alone. But again, I'm not. I'm very, very unknowledgeable about all of this.
Yeah, no, that's completely fair. And honestly, I look at the ETF stuff kind of in a similar light. Like, I'm not privy to the exact process that an ETF needs to go through to be approved. It's kind of why I've been looking at these two Bloomberg fellows, James and blanking on the other guy's name, Eric. And they've kind of been a good shining light for me personally. I mean, I know they got dunked on because they said there won't be meaningful demand for an Ethereum ETF. But I don't know. They're good at following and following along the progress of this, and they know the steps required to get one of these things live. But yeah, largely I agree with you. But with that said, there's a lot of other interesting things to jam on this week, so I do want to get into it. Cobie had a really interesting post on low float, high FTV tokens that a lot of people have been talking about for what feels like a couple of months now. This has kind of come to a boiling point where it's just like token after token launching at an absurd valuation. And it kind of got to this, a boiling point is really how I would describe it, where Cobie used Starknet in his example where, he called the valuations happening in like the shadow realm or the private markets where, VCs are essentially just outbidding each other, bringing this thing to like a multi-billion-dollar valuation. And by the time retail gets the first opportunity to purchase it, it's already at an insane valuation that it can't sustain. Thus, we see these down-only, low-float, high FTV tokens. My understanding and interpretation of this point was, we're seeing this meta where tokens are launching later, and tokens are launching at higher valuations with floats, like let's say less than 20%. Like optimistically, I think it's really more so around that 10% mark. And it's interesting because it's a really hard problem to solve. Like, how do you launch a token without a low float? Well, you have a couple options. Step one could be you unlock team and investor shares earlier or not at all. There's no cliff, right? That would have a larger supply circulating on day one, but that's kind of antithetical to the exact problems we're trying to solve. You could also not airdrop the token because then there would never be anything in circulation, because the initial chunk that goes circulating is that community supply piece that you essentially give to early participants of your ecosystem. Or you could airdrop more, right? You can, and I think we talked about this the other week, where instead of airdropping 5 or 10%, you can airdrop 25 or 50% of your token. But that's not always like the best case scenario for the business either, right? In the case of like an application building on top of any given blockchain, it doesn't necessarily need to be maximally decentralized, right? You don't need to give away 50% of your token supply as maybe like a base layer that makes a little bit more sense. And you want this like maximally decentralized base layer. So there's like a push and pull between how much of your token do you actually want distributed to the community, because it might not. I don't have any problems personally with having like businesses building on chain and being like a little bit more centralized as a business rather than like a fully community owned project. I think there's going to be a pretty significant spectrum of things there. But it is interesting to see some of these recent launches. Like, I don't know, off the top of my head, I think we've seen W and Pith launch both at multi-billion-dollar valuations. And in my mind, like that bridging Oracle infrastructure zone, I like really don't know if there's going to be a ton of value capture there. And at the end of the day, if you have a multi-billion-dollar valuation, you're going to have to justify it at some point. And so what seems to me is these tokens have launched at insane valuations that they have no hope of ever justifying. And when you have a token related to a business, it's like, I think you do need to justify it. I don't think you can have this like mimetic valuation piece to it for the most part. So what's happening is there's these very high value tokens that launch, essentially go public, if you will, by being accessible to the public, and they go down only. And so you get an upset community that is like upset with the product already, and now they're upset with a token because they're losing money, and it ultimately creates this like negative feedback loop where people just feel like they're getting scammed. And so like everyone's been trying to dissect why. And I have like a pretty simple thesis to this, is that VCs are willing to fund things at a higher valuation, which we should dig into why. Founders now have this decision to make. Do I take the higher valuation I probably can't fulfill, or do I take less money, which is a very hard call to make if you're the founder? And then the VCs will keep outbidding each other. And then by the time you're ready for TGE, your product goes live. The product's shit because it's been, being built for less than 24 months in most cases. And so like the onus is really falling on VCs and founders to have more reasonable valuations. So I don't know. I feel like this is sort of just like something the market needs to sort out, unfortunately. And what that really means is a lot of these things that came out in insane valuations trend towards more fair valuations, which will be much lower.
Yeah, I think that's well said.
All right, let's take a quick break to talk about Helium Mobile. Every month, I'm reminded of the pain of a phone bill for someone who is terminally online. Those data charges are no joke. Well, Helium Mobile is bringing a crypto-native solution to this. It's powered by a combination of a decentralized wireless network and the nation's largest 5G network to bring reliable coverage to its users. The coolest part for me are definitely the mobile token rewards. They're earned by sharing your location, which allows more people to build coverage where it's needed most. So effectively, the token rewards end up bringing a better product to the customer. But even cooler, you can take these rewards and pay for your phone bill directly within the app. This is a beautiful showcase of arguably crypto's two strongest use cases: incentivized user action and crypto payment rails. The phone plan is unlimited talk, text, and data, plus it's affordable at just $20 a month. If this sounds interesting to you, go to hellohelium.com to get 3 free months of service with the code LIGHTSPEEDMOBILE. Again, that's LIGHTSPEEDMOBILE, all caps, no spaces. Be sure to check out the link in the show notes for easy access. All right, guys, let's get back to the show.
There's a few angles here, but I have my own take on it that I posted on Twitter that I'll get to in a second. But yeah, part of the reason, of course, is that a founder will build something that maybe is promising, is a good team, and maybe it's similar to a trend of something else that recently took off. So like maybe EigenLayer, but on chain X or something, right? And so VCs get FOMO, and then they keep outbidding each other. The founder obviously wants the most founder-friendly option. Generally, this means the least dilution possible, with the highest cash possible. Now, that's actually not always a good thing, in my experience. So our seed round for Helios, it was actually quite low. It was about 3 million. And our competitors who had started before us had raised, 2 of them had raised over 10 million, and the other 2 had raised a lot, like hundreds of millions, an insane amount of money. And everybody was like, okay, this is kind of silly. How can you compete with these people with such little amount of money? And it's like, honestly, and this maybe ties into my next point, I think people are kind of just really mid-curving this, or maybe focusing on, if there's a picture, they're focusing on one side of the picture, but not the fundamental problem. And the fundamental problem is, you're correct, these are businesses, and the businesses need to do business things and generate value for some market, right? A business is essentially giving people in some segments of a market what they want in exchange for money. Okay, that's what a business is. Nobody's really, well, I don't want to say nobody, but a fair chunk of these teams are not doing that. They're either doing this in theory, in which they'll say like, okay, well, in 5 years, this will happen, and then interoperability will be a thing. And then in such a case, then we will need this if this also happens. It's like these ridiculously convoluted logical chains that you must evaluate for the valuation to make sense. But I mean, it's a story. That's kind of where the meme comes through, right? Like you can tell a good story, and if it lines up with another story that was true once, then it works. But I think, like, I'm super old fashioned. I think if you just build something that people want and use, then the token price, it'll be much easier to manage than if it's purely a story. Because a story, if it's not grounded in reality, has a lot of places where it can start leaking and start getting chaotic, and a story has to be managed. But fundamentally, ultimately, at the end of the day, you can't really cheat reality. And I feel like that's kind of what this isn't even specific to, like, just this past year, but it's been a recurring theme since the beginning of crypto. Really, it seems it's that the idea of people can just printing money out of thin air, and then they'll say like, oh, well, that's how the Fed does it. It's like, well, actually, look at the United States. Okay, is that thin air? Like that, it's not thin air. So I think, and it's like then the question is, okay, do you blame the founders? Do you blame the market? Do you blame the VCs? I mean, I think depending on the individual situation, one or all will probably be to blame it's not always the VC's fault. I can tell you that. VCs do get kind of a bad rep here because it's just easy to hate on them, but like they're generally not, um, uh, in my experience from what I've seen, there's a lot of VCs who do not do this things that you see on CT, like, oh, they're just going to dump on retail sales. They actually don't really do that because they would nuke their reputation, in which case they really wouldn't be able to pair with great founders going forward. And so, anyways, the TLDR here, in my view, is first build something that people want that is attached back to reality in some form, to some goods, services, exchange, something being sold. Once you do that, then I think the token is much more manageable. And then you can start getting interested in the physics of a token launch and stuff like that. But I think a lot of times when you do this backwards, it also, what it does is it dilutes your PMF, or what you think you have in terms of traction, which then goes back, since you don't now have PMF, now your token price goes down again. And so it's like this weird loop. Yeah.
Yeah, no, that's a great flag there. But like, who's at fault here? Everybody wants to point the finger at somebody, I think, but I agree with you. I think it is all three. Like, there's founders that know they're taking too much money, which Silicon Valley, the TV series, like that one clip here always gets brought up, where it's the two founders at the bar. One is like going through a hardship with his founding his company and like debating how he should raise. And he's talking to his friend who has like, recently just gone through acquisition, and like, it was like an unfortunate situation. And the guy who's like going through the raise asks his buddy, and he's like, what if you took less money? And he like kind of like unravels and falls apart, because he's like, oh, if I took less money, I would have had way more realistic benchmarks to hit. And if I had those, we would have never faced that down round. And then we would have never gone through acquisition. And now I wouldn't hate my life. And like, he like completely falls apart. But the onus there falls on the founder to be like, okay, no, I think this is ridiculous. It also falls on the VCs to be like, guys, like the 7-3 staking protocol is not worth $10 billion. And it also falls on retail, unfortunately. And like, if a liquid token launch is effectively still a venture play, right? Like, again, these products generally aren't live or have only been live for a matter of months. And so retail is being asked to evaluate these things. And I think they should have the ability to do that. But like, I think it gets lost in translation of, you need to make an educated decision on the valuation you're purchasing this token at. And I think some of that gets lost because, going back to the original point of, Bitcoin, Ethereum, Solana, like these are sort of like these digital economies, and it genuinely is harder to value these things in a fundamental way. Whereas a token launch for a DApp that is like generating fees and has a purpose, like, this is going to look a lot more like a traditional valuation model, in my opinion. And so therefore, again, these things need to be grounded in some sort of a reality. But that kind of brings me to the next discussion, which is one of these potentially high float, low FTV protocols of EigenLayer. Justin Drake has been taking some heat. So he works for the EF, the Ethereum Foundation, has been instrumental in a lot of Ethereum success on the economic side. And he's kind of like taking some strange heat right now. So he got an advisor allocation into EigenLayer and came out and said, like, hey, just so everybody knows, this is going to make me life-changing amounts of money. So it's interesting because some of the risks of EigenLayer are that it'll like overload the social consensus layer of Ethereum, create a fork situation where Ethereum kind of needs to decide. And EigenLayer was now disclosed that EigenLayer has advisors that are also on the EF, right? And so you kind of have this like interplay between these two major protocols that could down the line have like conflicting odds of what they think is best. And so it's interesting to see some overlap there. People on Twitter, of course it's Twitter and you really can't take it seriously, but they're like shitting on Justin Drake, being like, well, why would you do this? Like, you're a terrible person. I'm like, you go get a 7-figure deal and be like, you know what? I'm not going to take that. Thanks, guys, but I'm going to preserve my imaginary morals here and just do everybody else a favor and pass this. Like, that's complete nonsense. Justin Drake has long proved his dedication to Ethereum, and like, you have to. This is just part of the world. Like, this is how the world works. This isn't a crypto problem. This is basically lobbying. So it is kind of interesting to see. I don't think you can really have a problem with it, but I'm curious if you have any thoughts here.
No, I don't have a problem with it at all. I think anything that's of that nature, as long as it's properly disclosed, I think it's totally fair. And yeah, Justin Drake is definitely has put in the work. You can see the things he's influenced, the hours he's put in. I mean, he's on our Solana research group, for example, asking questions about Solana. So I have no doubt of the integrity of the person in any way. I think, and by the way, I didn't look into this that much. So correct me if I'm wrong anywhere. It seemed like what people had a problem with mostly was that it wasn't disclosed until after Cobie tweeted. And I believe Cobie's tweet was to Vitalik's tweet, which was something like, I'm glad Ethereum now has, or I'm glad Ethereum has conversations in the public, even if it's super disfavorable to the protocol and stuff. And then Cobie's response was kind of like, well, actually, Ethereum has the socialite layer that nobody really talks about, and it kind of annoys them because people are, in a sense, LARPing. I also tweeted back as kind of a troll, not really serious, saying, but okay, but why did all the ETH influencers block me on Twitter then? And I think it's interesting because I think everybody has a point. But I do, so if I were to, I think the difficult part here is like, would Justin Drake have disclosed it if it weren't for Cobie basically calling that out? And I actually think the answer is yes. I think he would have. I'm not sure on the timing because I angel invest, and it's not like something you rush to do. Like, it's generally not necessarily on your mind, and sometimes the team might have their own announcement that you're trying to cater to or something. So there's a lot of random things. So it's not. I think Cobie was right to call it out, and he should always do that. And I think we need that. But I also don't think Justin Drake really did anything wrong. Probably my problem with the whole ordeal would be that I actually think Cobie is right in that it is, because Vitalik and then that person that I really don't like, Eric.eth, said something like, oh, well, like Ethereum does everything in the open, not in hidden discords. And meanwhile, he's the one who was begging all the ETH guys on Discord behind closed doors to come back and post on Twitter. Okay. And so, a little hypocritical. Uh, but I think you'd be just lying to everybody listening to this and anybody who has any brain cells if you think that everything about Ethereum happens out in the open. It does not. Okay. I don't think there's anything, with the exception of like, I don't know, maybe Linux or something, that actually happens all in the open. There's a lot of these weird political plays, pay to plays, and social dynamics that happen that influence certain things that not everybody sees. And I'm not sure if you can ever avoid that. Just as you said, it's kind of just how the world works in a sense. You can obviously be more forthcoming and be more transparent and have people in the community like Cobie and whatnot to call it out. And certainly you need that. But like, let's not pretend that that is not how also Ethereum works, right? There's a lot of weird like alignments. The entire concept of alignment kind of proves this. And how certain L2s were able to close certain deals and certain others weren't. And now they kind of fight with each other, but only behind closed doors and not really publicly. Same thing happens on Solana to an extent, and I'm sure every single protocol that has any sort of stakes at play. So the TLDR for me is, I don't think Justin Drake did anything wrong. I think what Cobie is doing is useful and should be done more, and I think he has a fair point. And I do disagree with Vitalik that Ethereum is this protocol where everything is out in the open. I don't think it is. And it's not a knock on Ethereum. I just don't think that's how anything works. So.
Yeah, I agreed on all points. And just to put an exclamation point on the last one, like, that's not a crypto problem. This is, again, just like kind of how things happen in general. Like, even within a business, right? Like, even a smaller team, there's just, even if it's not intentional, there's just conversations that happen that like can push things forward. And, maybe one person's not aware of it. That's not an inherently evil or bad thing. That's just how things get done sometimes. But yeah, I don't know. That's one of those pieces that people like to obsess over. That's probably like that doesn't make Ethereum centralized, just or something like that. Just because there are conversations that happen in closed doors. It's like no, it's just more efficient, and not everything needs to take place in a forum. It's just good to like use that as a reference board and keeping people in the loop and giving an opportunity to share opinions and pass forwards and advice and et cetera, et cetera.
Yeah. And like, you don't even want everything to be out in the open either. Like, there are certain things like security incidents, like war rooms, etc., where you actually don't want this. Solana, by the way, does do it in the open, sometimes to their detriment. People think Discord is like this private thing, but it's a public Discord. You can just go in and join. Anybody can join and see everything. You can see the core devs yelling at each other all the time. That's how you're probably seen, if you're following Solana, you've probably seen Trent on Twitter now. Just imagine that, but on Discord for the past like 3 years, in probably less PC. And like even the other, I don't know if you remember, but there was a period of time where there was a high skip rate for Ethereum blocks a few months ago due to I think it was a problem with blocks route or one of the MEV kind of parts of the system. And there was a lot of, and this was due to the blob space being like super congested.
Yep.
And it was probably like the worst performance degradation that Ethereum has seen, based on what I'm just paraphrasing the other core devs that were saying it. And one of the core devs was like super frustrated, like, hey, who's solving this problem? Why is it behind closed doors? I don't know where to join. Like, is there even a Discord and stuff like that? And so like it does happen. Uh, Nobody's perfect here.
Yeah. What do you think about this idea? I think this might have been Eric .eth that was pushing this. Sorry to strike a nerve here. But what about the idea that like Ethereum's narrative or social presence, let's say, has struggled given the move to Farcaster? And like I have a Farcaster account. I don't use it too often. So like I don't even know if it's true that a lot of the Ethereum core dev conversation has moved over there. But like that's what is often touted. Like, what do you think that that's kind of been moved maybe over into the corner and out of the limelight of the average crypto user? Do you think that's played any impact at all into the price performance of Ethereum or like the recent kind of change in tune? It feels like ETH is getting a little bit of that like hated asset vibe to it.
Yeah, I mean, it's one of those questions where you can't actually determine any sort of deterministic link between the two. You can just guess. But yeah, I've seen this a lot in the past, let's say 3-4 weeks. And actually, I noticed this when Farcaster kind of had their huge moment a few months back, and then it kind of kept going down because due to these huge amount of, and we actually had Dan on the show as well. Um, there's this thought that since people are now posting in another social media channel, that means that the asset's price is low because they're not posting in the main social media channel. Now, that is, I think you could probably make somewhat of an argument for how that could be somewhat related. Um, but I think it'd be a very weak argument. Basically, you'd have to say something like, okay, if Vitalik only posted on Twitter instead of Farcaster, what happens to the price of ETH? Okay, that is super highly speculative. In fact, Vitalik has started posting in the past few days, it seems. And the price actually is the SOL ETH chart. If you look at it, it's actually at an all-time high now. Okay, so it's actually much worse. And then you ask the question like, okay, what percent of people holding these tokens and buying these assets do so because of what they see on Twitter? I have no idea. Like, people have told me that they've bought Solana because of me, and I'm like, I kind of don't believe them, because it's like, I'm not sure if that's like, you must have some actual thesis first, and then maybe you look at Twitter for like confirmation bias. Rare instances, you'll actually change somebody's mind with a sound argument, or maybe show them something that they weren't aware of before to make a better decision. That happens, but it's really not the norm on Twitter. It's more like a circus, I would say, where it's kind of just look for entertainment. And so I think the problem is not just the problem is not people also posting to another social media account. Okay, so for example, I'm also on Farcaster. I do post on it, and I'm actually the mod for the Solana channel. And I really like Farcaster, and I talk about it all the time. Okay. If you consider me as as a good proponent of Solana, okay, and also add the fact that I post on Farcaster frequently, like, are you now going to say that Sol's price should be affected? It just makes no sense. I even invest in other ecosystems, L2s, L1s, right? Like Barachain or Monad, for example. Like, it's just, I think it's a very attractive narrative because I have seen like a decline in, let's say, the smart takes that I've seen from Ethereum, but those people are now working on things on top of Ethereum, right? So the L2s, for example, like Jesse from Base, for example, right? I'm not sure if you consider him Ethereum, but he does post about the vision of Ethereum and modular scaling in Base frequently. The Celestia guys also do this. There's all these interoperability solutions, right? If you actually look at it, there's like 5, 6 people from each L2, plus like 100 people still on CT from Ethereum, plus Celestia guys, plus interoperability people. There's so many folks. In fact, Lightspeed was started in some sense because Solana had nobody and just zero sources of information, right? Solana has like Anatoly and Ansem, and I mean, that's kind of it.
Mert.
I would
Solana
say,
has Mert.
and but like, if you look at the raw numbers, it's super skewed towards the other side of the roadmap. If you look at the VC funding, like, compare how much Solana projects get versus how much this roadmap of Ethereum and L2s and modularity and stuff gets. It's just like, is that even comparable? And so there's money, there's numbers, and I think the forecasting is a scapegoat, to be completely honest. I think the fundamental truth here, or one of mine at least, what I believe, is that Solana just works well. Like, we've been really trying hard to get apps to build useful things on top of this chain and deliver a good user experience for people, like Phantom, Magic Eden, Tensor, right? Jupiter. These are all solid products. Like, you use them, you're like, okay, this is good. And if there's a problem, which there often is, it gets fixed. Like, for example, congestion was a problem for like 3 weeks, then it got mostly fixed. And now you don't really see the same issues anymore. Now it's not fully fixed, but it has improved fast. There's like this super fast iterations, which sometimes increase the risk for an outage. That's another story. But I think because now, as if you're in the Ethereum ecosystem, you kind of have to pick and choose, like, okay, which L2s do I believe in? Do I buy their token? Do I buy Ethereum's token? How does this play out? There's so many conditional chains of logic there to make, I would, if I were investing, like a good investment choice, in my view. Whereas on Solana, I'm just like, okay, there's Solana, the token, you use it to pay gas, everything is on top of Solana. That's it. Right. That's kind of how I see it. And maybe I'm totally wrong on this, but the one thing that I'm pretty sure on is that it's not Farcaster's fault that Ethereum's price is like, Farcaster, by the way, I think might be the most impressive team on Ethereum. Like, they're all early Coinbase people, and they built a really good product. Like, it's the only product I actually use regularly that's in crypto, and it's on Ethereum. So, like, using one of the most successful apps on Ethereum to say that, oh, well, this is why Ethereum's price is going down, is just, a little freaky to me.
Yeah, that's what you call cope right there. I agree. I think that's not the channel of communication is not playing an impact here, in my opinion. Totally agree with your points there. My friends, big news. Blockworks is hosting Permissionless 3 in Salt Lake City this year. So we're heading west for 3 days starting October 9th. Permissionless is our industry's premier DeFi event that brings together crypto natives from all over the globe. I've personally been the last 2 years and can honestly say that the attendees are incredible. It's people who actually care about crypto. We'll also have more than 200 industry titans speaking at the event, and this includes builders like Lucas Bruder from Jito Labs and Brian Pellegrino from Layer Zero, or investors like Kyle Samani and Joe McCann, and even elected officials like Representative Tom Emmer, who's fighting the good fight in Washington. And it's narrative season, so we're going to be covering the 7 hottest themes in crypto. This includes things like modularity and restaking, or Bitcoin and L2s, and even AI and crypto. The goal is to keep you up to speed on major developments in the industry. Ticket prices will be structurally increasing over time, so get your ticket today. For my Lightspeed family, I got you. We're going to use code LIGHTSPEED10 in all caps, no space, for 10% off your ticket. All right, everyone. I look forward to seeing you at Permissionless 3, and let's get back to the show. I'm curious if you think there's a difference in the community's approach to problems, right? Like, Solana is in this like go fast and break things mode, or was, I would say, and is kind of like taking their foot off the gas. They're like, all right, we've got a single client. Like, we actually do need to be careful. And it seems like there's been a slight change in tune now that there's users and TVL and volume happening on chain, and going down is like a serious detriment to that. I think once we get FireDancer live, the idea is Anza and FireDancer teams can kind of push their clients more aggressively. To me, that kind of seems like one of those things that sounds great in reality, but I'm curious to see if that pans out in practice. And I guess to expand on that, if you have a single client, the risk of pushing a bug into production and taking down the chain is obviously very high, right? Every update it's make or break. There's only one option. If you have a second, that risk drops tremendously because there's a second portion of the network that is keeping the network alive. So the idea is that both teams will be more willing to push. I'm curious if you think that's, before we go into the broader question, like, do you think that's true? Because again, in my head, it sounds great in theory, but if you're the one in charge of either team that's responsible for pushing the button, you probably don't feel that way.
Yeah, it's a fascinating thing to think about. I would say, certainly, though, I think you can make a safe enough argument to say that when there's two clients, then probably the velocity of shipping increases as opposed to just one client because of the risk inherent. There's no fallback on a one client system. And so I do think that helps. And there's actually, I believe, a third one by Syndica. Um, I'm not too sure what's happening with that one, to be honest. But at the very least, we can say, okay, with two clients, it's going to be easier to ship changes without fear of death, in a sense, right? I think like Tolly's biggest fear is, okay, maybe there's a day zero, there's a security bug in one of these clients, and there's no fallback, and now the chain is just down, right? And it's a fair worry. So yeah, I think again, the argument that two clients would lead to two or faster development cycles in theory makes sense. And then your question is, does it make sense in practice? And I think that'll depend on just kind of maybe the stakeholders of Solana and the willingness of validators and what they think after like we play this out and kind of put it on the market. Like, how involved is it? Does it punish what are the mechanisms set in place to do the fallbacks? Is it a very manual process, etc.? I think a lot of it just comes down to execution. But if it's already good in theory, then I think there's a set of problems that you solve to get to implementing it in practice. And Solana, if there's one thing that the network or the ecosystem has shown, is it can ship super fast, right? It was super vulnerable to UDP flood attacks about 2 years ago, and it got fixed with Quick. Okay, now Quick, the library that they used in Rust, Quinn, turns out not great. Kind of dies under massive amounts of scale. Okay, now we're going to rewrite that. But while we're doing that, let's put this patch so that the network works. So it's very engineering kind of driven iteration. There's a book by Matt Ridley. It's called something about how innovation works or something. And basically he argues that all feats of engineering that are like that you think are super impressive actually all started as like some shitty idea and then just kept iterating slowly. And then you look at it in some longer time horizon, you're like, okay, wait, wow, that is actually quite impressive. I think that seemed, and like, for example, Totally has a saying, I'd rather be in prod than be proud, right? And then I think Trent has one where it's like, all the wrong decisions were the right decisions, right? Like all along. So you can kind of see it. And then like Lucas will say like all gas, no brakes or something, the CEO Jito. And then I just say some incoherent rumblings. But I do think it's certainly comparatively speaking, more baked into the culture on Solana. And it's not always good. Like, obviously, if you have some lending protocols, if I were them, I'd be like, wait, guys, like, stop. And so I think there's definitely arguments to be made for both sides, but I think the cultural difference is pretty apparent. Whereas Ethereum, actually, Dankrad posted something. I think it was quote tweeting something that was from David Phelps, which was something like Cosmos, something sovereignty, Solana is like something global state machine, and then Ethereum, it was just the entire roadmap, and it was like super complex. Which, by the way, if you actually pulled out the roadmap for all the chains, they would all look that complex. Just saying. But and then Dan Crab was something like, well, actually, Ethereum is the only one that's solving all the necessary problems and stuff. And I wasn't a big fan of that take, because it's like, how do you know what all the right problems are? You can't really know that. The market can tell you if you're right or not after you put it out there. But it's not clear that anybody, Solana included, is solving the right set of problems. So the best thing to do, it seems, is pick your values, right? Maybe it's iterating fast. Maybe it's doing everything from a very robust research perspective. Pick the values, execute them, see what happens, and then crypto wins either way, right? So
yeah, I would argue. I saw that debate. I would argue that that's what he was trying to do, but he tried to put some marketing spin on it, and maybe that's not his forte. He's certainly a gigabrain engineer, though, nonetheless. Yeah, I don't know. It's, to me, I think there is merit to like the Ethereum narrative, if you will, and like what people think of the asset has clearly shifted over the last 6 months. It feels like it went from like this consensus asset that was everybody's favorite take on blockchains to like, hey, maybe what they're doing doesn't make a ton of sense. And to me, that's really all that signals in my mind is they've kind of like solidified this view that they are going to inherit value or derive value from the use of their currency as money on L2s. And last segment we did, or last week's episode, we went over like the total economic value captured, which is essentially the amount of fees that our users are paying into your chain, into whatever your network is. And like you can see that Solana the last 3 to 4 days now has eclipsed Ethereum on that metric. And it's just a different strategy, right? Like, so Ethereum is relying on the use of an ETH asset on rollups and L2s as a value driver for the chain, which probably, candidly, that probably means you look way more like a commodity, and that probably means you go sideways, like maybe a couple degrees up instead of just like a full up only chart, as ETH's history has shown and proven. If there's no like cash flow drivers, that's probably just a less interesting asset to more people. And if it's just a harder story to sell, I think. So they've kind of like went all in on this one narrative, and it's kind of having this result of like, hey, is this the best option when, now that there's chains doing other things that are gaining traction, right? I think Solana has like really proven that there's going to be alt L1s that gain traction. I don't think Solana will be the only one. I think you're going to like, there's been plenty of great experimentation in the Cosmos. The Avalanche team is pushing VRIX as their new custom VM that looks to be very fast on some of the dev nets. And we're seeing a lot of rapid experimentation on like the likes of the Move world, with Sui and Aptos kind of leading the charge there. Like some of these things are going to get meaningful traction in one way or another. And yeah, to me, it's kind of like proven like, hey, if we can scale the base chain, maybe we don't need to do all this like fancy roll up nonsense, right? That's just like two different views, and we're going to see which one works. But if we hold true to the Solana view here, Tolly had this really interesting tweet. He quote tweeted Georgios, the CTO of Paradigm. Paradigm is building Reth. Reth is like, what's a Solana parallel would be like the fire dancer for L2s, basically. Reth is rebuilding the Go Ethereum client in Rust, and has a significant performance improvement for Ethereum or EVM based chains. So the idea is that like basically L2s will probably more than likely run Reth on their sequencers, and again, experience significant performance improvements. he in this tweet thread, Georgios noted something to the effect of like the cost of replication is quite high for L1s, and totally tweeted it and was like, please stop with the bad L1 math, and went on to go walk through some numbers. So can you walk us through exactly what this calculation means, and kind of like what your views on this debate are?
Sure. I think in the equation there, he's using 350 per month, which is the monthly cost of, let's say, a box on Solana, from a bare metal provider. 17, 13 times, that's the number of validators on Solana, and then some rough TPS for the average per month, and then the seconds per month, and then he says the incremental transaction costs. And then the other one's going to be for storage. And I think this is kind of the interesting part. And by the way, I'm not sure exactly if you actually click on Georgios's post. I did reply to it, just not in like a dunking way, but because I think this is something that most people don't quite grok about Solana, or maybe appreciate about Solana, which is that so Georgios, and I hope that's how you say his name, um, argues that NL2 will always scale better because it has less of a replication factor. Um, Now, Solana is actually not like it's quite underappreciated how it's able to scale it by adding more nodes, but without introducing additional overhead, right? Proof of history, like one of the core ideas behind it is the nodes don't have to talk to each other. They all keep their clock internally. That reduces overhead. And then Turbine is probably the most interesting part about Solana with the data propagation. Um, Now, if you take it to the very extremes to the physics, yes, I think obviously multiple machines is going to have more replication costs than one machine, obviously. But it's not like that doesn't come with any compromise, right? There's real-time censorship resistance compromises, which you're almost always going to get with an L2, as far as I'm aware. You could probably use something like Astria and do decentralized sequencing, and maybe that gives you some sort of real-time censorship resistance. But there's always somewhat of a compromise. Like the replication is there for a reason. It's not there to introduce inefficiency. It's there to provide safety, some sort of guarantees. Um, so, anyways, I think they both made good points. And if you scroll down to my point, I think yeah, okay. So basically, this is the crux of what I think, which is that I think the L2 way of doing this, I think it could work, and I think it will work, but I do think it's quite complex, and so I think the path to get there is going to be harder. And I think obviously it should be taken because I think it's not good for crypto. But I don't think it's like I wouldn't feel comfortable saying the statement an L2 scaling this way is better than the L1 scaling this way. It's a different way of getting to some end goal. Okay. Better or not depends on what the market values. Okay. Um, so like for example, if they don't care about censorship resistance, real-time censorship resistance at all, then maybe it doesn't even matter. Then it's totally fine to do it this way. Um, and so I think I always kind of come back to this with the roll-up versus L1 arguments, which is that I think it actually entirely depends on which use cases actually are the most important in the future. If it's things like global finance requiring atomic composability and low latency, you have your answer. Okay. But if it's like games or things that are like Farcaster, for example, which don't actually need the chain or global state at the very least as much as we would think, then by all means, an L2 makes more sense for that. Okay. So I think it totally depends on the distribution of use cases. And then the other final point I'll make here is I think like one of the points that I see often is something like, well, one chain can't scale to meet all the world's demand, which is like a counter argument against Solana. Well, one, I don't think anybody's claiming that Solana actually tries to handle the entire world's demand. That's just some hypothetical thing that people construct to fight against, but it's not really the case. Like people will use different solutions. Um, and the other part of this is if you're like super hyper optimistic about future demand, then there's actually a point in which Ethereum's supply, even with the roadmap fully realized with the sharding capacity, actually will fall short beyond some threshold X. Okay, and at which case you'll want to make sure you have the most hyper optimized base layer. And so then maybe actually an L2 on Solana makes much more sense. Okay, or maybe on Monad, for example, right? Just kind of putting it out there. So that's kind of I think both have good points. And I think I don't want to sound like, an Austrian, but I think, and I don't really believe in Austrian economics that much, by the way, but I think the market will kind of decide while we argue amongst ourselves.
The market will decide. Cop out answer. No, I'm just teasing. Slightly adjacent to this, I saw Drip announce that they were running a validator. I thought that was cool that businesses are running validators on chain. I think Solana uniquely encourages that with stake weighted QoS. But you had a response to me that was like, they're not actually running it. Is it something to the nature of like, and like who's running it? I don't really care who specifically, but more so is like, is there a node provider that's like opting in to run it for them, or like what does that relationship look like? Do you know?
Yeah, so generally it'll be a node provider like a block daemon, for example, who will run validators as a service for people. And I really don't like that practice because it's a point of central failure in a sense. For example, I just tweeted yesterday that Conduit, the SaaS provider, roll up as a service provider, controls the admin keys for over 12 rollups. That's crazy. I had no idea that was true. L2 Beat, the guy, the co-founder there, actually showed me, and it's insane. And by the way, you saw this in practice where Degen chain went down because of Conduit, and it had like a 500,000 block reorg or something, like a 49-hour reorg. So that's kind of one of the risks it opens you up to, and at the L1 layer. In this case for Drip, it's actually it's another validator. It's not a validator as a service company, but it's another validator. And then Drip is putting an LST on top of it, and so that it's kind of like maybe Drip is kind of the front-facing business distribution kind of side of it, but then the ops aren't actually managed by Drip at all. I personally think that's super bad for decentralization and security, personally, because it's like the way I think of the staker validator and a network relationship is kind of like just how America works. You elect people, they represent you in some place like Congress. Okay. Like you delegate your influence to the validator because you think the validator will represent you well or has the network's best interest in mind. And then they actually do that. Right. But if you kind of sever that such that the front end is different from the back end, okay, you don't know whose values represent what at this point. Like if I delegate to Drip, I have no idea how they would vote in anything. I have no idea what the value underneath would do. It's just kind of a. I
Does
haven't
Drip
made
still
up.
get like the business benefit of running this? Like, okay, so Drip, my understanding is they have to execute a shit ton of transactions on behalf of their users. So when costs are high or congestion is bad, they suffer. So if they had their own validator that had, let's say, meaningful amounts of stake, and then they could get transactions to the leader, like that seems in my head that it would benefit them. Like, first of all, would you agree with that? And second of all, like, if someone else is running it, do they still get that benefit?
Oh, if you're referring to the stake-weighted QoS benefit, that's not really going to make sense here. Because first, unless they have like a virtual override directly with the validator and they connect directly without any RPCs, that could work. But like in general, stake-weighted QoS is kind of a farce, which we can kind of talk about later. But it doesn't actually guarantee that anybody respects the stake. So I don't think it's going to help them in terms of landing transactions. I think I think Vib's comment was something like, because 7layer, who runs a validator called Overclock on Solana, said like this doesn't actually help decentralization on the post. And I think Vib's answer was like, I don't care about decentralization. I want traders to get paid. So I think probably they want to get some sort of rewards from the validator and then distribute that to traders in some fashion, which is interesting. Let's see how it plays out. I think it'd be much better if they ran it themselves. And I say this to everybody, because what you don't want a lot of validators on a network. Okay. You don't want a lot of validators for the sake of just being validators. You want a lot of engaged, active node operators who really care about the network, understand how to troubleshoot it, and communicate things, fix it, improve it. And that's how the network improves.
But how hard is like the technical edge required to run, like properly run a validator, such that you're adding a benefit to the network rather than like creating a drag for the network? Because if it's like Drip, for example, that is not their core competency to run a validator. I'm sure they could hire someone to do this, of course, but that's an extra cost. So I'm thinking like from the business perspective, if you just want the benefits, what's the burden of running a validator?
It is relatively involved in terms of DevOps. Like you should at least set up, fallbacks and replicas in case one of the instances goes down. You have to manage your keys properly. You need to be obviously quite comfortable with Linux, SSHing and all that. It's generally, I would say any engineer can actually do it. Like any engineer, including like a front end person. Then it becomes a question of what are the company priorities. And generally that's kind of where the divide happens, because as Drip, you don't care at least about having like a dedicated DevOps team, right? You're mostly consumer facing, right? And you're a scrappy team. So you probably don't have resources for this or don't want to focus on it. And so does it make sense to delegate to, this concept of like spinning up your own LST on top of another validator is like relatively new, so I haven't formed full thoughts around it. I would guess that what you would want to do is delegate the stake to another validator. But if you want to do an LST on top of it, I think then it starts getting weird. But we'll see. I could be totally wrong. I could be 100% wrong.
I was taking you down this line of reasoning somewhat intentionally because I can't think of another example of a proof of stake chain, Ethereum, the Cosmos, Avalanche, whatever it may be, where somebody has had like this style of a motive to run a validator, right? Like usually it's just, I want to participate in the network or make some money. I guess this one really is kind of like profit driven, but they want to pass it back to their users. But I don't know, like I find it really interesting that like Tolly again has always pushed this idea of businesses will run validators even at a loss because it will add benefits to like, it's just a line, it's like a line item in their cost of goods sold, right? Just a line item that's a cost to them, but they get benefit such that it makes sense for them to do it. And like, this is kind of like a unique example of what that seems to be true. So I don't know. That's kind of why I wanted to wander down this path. I don't know if there's any other, like, okay, let's take Ethereum, for example, like what you wouldn't really get a massive benefit running a node on, like, it's just a different construction there too. So it doesn't really make sense.
I think like one of the dangers is these start, like people now think that Solana's validator count and decentralization has really gone up or something because of these things. But that's not necessarily true. If you're just spinning up more LSTs that delegate to the same validators that exist, or validator as a service shop spinning up validators on behalf of other people, you haven't necessarily increased security or decentralization. And so you might be giving yourself a false sense of, accomplishment there. It could be useful for other things like DeFi ecosystems, right? And because now there's more liquidity around staking and stuff, maybe that's good. I don't know. But I am very wary of inflating network metrics because there's nothing worse than a false sense of security in insecurity, right? It's all good until one day it's not, and you're like, fuck, right? Like we should have seen this coming. And so that is what I'm wary of. And sometimes you are making certain actors much more centralized than they should be, or they could have gotten on their own without this. So people say like delegated proof of stake has centralizing factors. And I think it is true. I think you do have to fight against it in some ways. And nobody actually nobody can actually quantify this. Like nobody can say, okay, well, this is decentralized, this is not decentralized, which there's always a degree to this.
Right. And I think it's
maybe
because there's so many important components to that word, right? Decentralization. That's like cool. I think your first thought is, oh, it's node count, which we can talk at length about why it's not. We even talked about this last week as it pertains to Ethereum, right? And it's like there's other factors there. For Solana, my understanding, and please jump in if I'm wrong here, but most people don't like run at home validators. It's kind of just not a concept. And you rent a rack from a data center, and that's where you're running it out of. So you have like data center concentration. You have geographic concentration for like things like political risk and regulatory risk. And so it's like not just like one stat you can point to that's like, oh, yes, this checks the decentralization box. You really need to take a more holistic approach. And I think you're really right for shedding light on like, yes, there's this like rise of LSTs. I think Sanctum's doing really, really cool work. I actually don't know the full length of like how Sanctum LSTs work. Like, do you know if they're just delegating to like single validators and like creating LSTs on top of that?
well, they have their token infinity. I'm not too sure how that works. With us, they helped with like the staking, liquid staking program, and kind of doing it through their platform. And it's good because when people integrate Sanctum, they generally, I think, tend to include everything else within Sanctum. So like HSOL, like Helios's LST as well. So yeah, but going back to one thing, for example, the data center concentration thing is totally fair, and stake pools actually look at that now, or I mean they've been looking at it for a while, but especially now, where you get higher delegations and higher validator scores, by the way, on like the reputation scoring sites for being located in places that are less represented. One of the stats that I think is like crazy is that Solana is in more data centers than most networks have nodes, right? So it's in like over 450 or something data centers.
That's a
Not
pretty cool
just,
stat.
yeah, it's pretty wild because like for you to execute some sort of an attack, you would have to simultaneously shut down an insane amount of jurisdictions at the same time. It's just not going to happen. Um, and yeah, I mean, most people, I don't think really many people do at home on Solana. I do know there are a few that have done it. So it's not impossible. It's certainly possible in the West, but in probably places that can't get really good internet, it would be tough for now. But again, that is what Firedancer is helping with. And I'm pretty sure we'll get there.
Well, fantastic. I appreciate you coming on as always. This is another fantastic episode. It's a pleasure to co-host these with you. And to the audience, we will see you all next week.